Welcome to the Scholar Advising Podcast. In this episode, we're answering questions from physicians navigating complex financial decisions. We'll cover retirement plan options for 1099 income, how to save strategically when your earnings are varied month to month, and what to consider when burnout makes you wonder whether or not you can afford to slow down or retire at that time. Plus, in our special segment of the week, Advisor Red Flags, we challenge the advice that maxing out your 401k is all you need to do. So let's get into it with our first question. The first question today is, I work as a locum tenens physician, so all of my income is 1099. Since I don't have access to an employer retirement plan, what types of retirement accounts are available to me? So this is a common issue that comes up when you have either 1099 income completely as your entire salary or entire compensation or as a portion of it. So there's a few options that you have because ultimately it's going to be your responsibility to set up any type of retirement plan. You can go the route of the SEP IRA or you can go the route of the solo 401k. The downside of setting up the SEP IRA is that your SEP IRA is going to remove your options of a backdoor Roth in the future because the backdoor Roth pro rata rule will actually take into account all IRAs, including the SEP IRA. So it's pretty rare that we'd recommend a SEP IRA unless you already have some large IRA balances that you can't get rid of, but even then you can roll some of those into a 401k. And the solo 401k is a really nice option as it allows you to contribute the same amount max as a SEP IRA, but because it's listed as a 401k, doesn't preclude you from doing any type of backdoor Roth contributions in the future. So that's the cleanest way to go. Now, I do need to point out that if you go down this route, right, and sometimes the 1099 world is misconstrued with just purely self-employed income. If you're running true 1099 contract work from another organization, then solo 401k is a great option. If you have self-employed income that's not necessarily only 1099, or you have a business that is maybe not directly in the medical field for those, then you need to start worrying about employees in the future. If you start having employees in the future, then you can't do a solo 401k. You can do the SEP, but you can't do a solo 401k and you're going to have to shift your plans around. So we always recommend looking ahead a little bit to see, is this a business where it truly is just 1099 locum money that's coming in and that's it? And you're just going to do that as a business and have that as a solo 401k option. But if you're going to go that extra step from a business perspective and you start having employees, then that does change the dynamic of which accounts you're going to have access to. And picking those plans now can save you some heartache. I know we've had that issue in the past where someone goes and opens up a solo 401k and then a year later they hire an employee and now their solo 401k has to be rolled over to a new 401k and you end up creating this big mess afterwards that could have been avoided if you just thought ahead a little bit and said, is this truly a solo gig that I'm dealing with, or is this something that's going to grow into something bigger? Right? Regardless, when you're making that plan selection and you're going after solo 401ks, some good providers out there. Look for low-cost index fund options. That's going to be really big. You don't want to get into a solo 401k that has a bunch of really high-cost funds at 1-2%. So stay in the low-cost world. A good bond fund is important, which I know sounds odd because a lot of people look at the 401ks and start thinking, I want to be in equities. That's completely fine. But if you're in the solo 401k for a long time and you're likely going to be saving in a brokerage account as well, then with a good asset location strategy, you're going to be focusing a lot of your bonds into that 401k as opposed to your brokerage account. So you don't want to be stuck with some bad bond options there as well. But that should be the main considerations you've got as 1099 contractors. I'd look more at that solo 401k opposed to the SEP and take some extra consideration of what type of business you're looking to run out in the future and what type of plan options that are available to you on the fund side. So for our next question, we have, I'm a physician in private practice. My income varies because I'm paid based on revenue share. I want to save more aggressively for big expenses like a home renovation and a college fund for the kids, but I'm nervous about committing to contributions I may not be able to sustain. How should I approach this? So super common issue, especially today with even a lot of hospitals have moved to this type of scenario where you're paid on a portion of production or revenue. So not an uncommon problem. And frankly, it's not an uncommon problem outside of the medical field as well, right? Where this becomes very common in things like banking and law or any type of place where hours are a consideration. So the way that's been handled and the way I'd recommend handling it is eventually you start looking at how much of your income is a base, right? How much is safe right there that you're going to be living off of. Now, the question is over time, the bonus amount starts to get larger and larger where you have to start living off of some of that bonus money, some of that production money that you're going to have. And that's typically where we start seeing this type of question is before when I was able to live off my base or it was only base that I was being paid, everything was fine. Now I'm getting to a point where I can't live off my base anymore. Majority of my compensation is coming from bonus, not salary. So how do I handle paying for things or saving for long-term things, especially when you start locking up money in different assets or accounts? Right? House is a good example of this. You go through and now you end up having a home renovation or a house, like in this scenario with the renovation where you have to go spend $100,000, $200,000 on a major renovation, and that money's gone now. So if you need that money out in the future, it's not like it's sitting there in a brokerage account for you to be able to use. So a couple ways to handle this. One is the traditional emergency fund, buffer fund that exists where instead of going from 3 months of savings, go to 6, right? You can even push that back a little bit more, especially if you have a wide variability there. So building up that buffer would be the first step. Now, assuming that's already done, then we have to start thinking more strategy-wise around how you handle cash flow. The issue with a lot of these situations is once that bonus, and I hear it all the time, bonus hit my account, but I don't know where it went. It just disappeared. Just somehow things came up and I don't have any money left over from it. So we want to try to force a stable income out of a lumpy income. So anytime where you have income coming in, keep a certain amount going to your normal checking account, and the rest of it should shift over to a brokerage account. And it doesn't have to be the long-term savings brokerage account. It can be we consider it like a short-term brokerage that's going to have a decent money market amount that's being paid. And some places will actually allow you to set this up where you have direct deposit to multiple locations, where you can set up X amount going to your checking account for normal family expenses every month. Anything above that gets shifted to the brokerage account. What that's going to do is on good months, that brokerage account is going to get a lot more money, right? And on bad months, it's not going to get anything. So in situations where it actually drops down and the brokerage account's not getting anything, or you're having to not get much of your direct deposit into the checking account, you at least have a brokerage account to fill that gap to create that stabilization. Now, when you start going into these big expenses or saving for college or even saving for some retirement accounts that are out there, I recommend doing that in lump sums as opposed to the monthly amounts, which sounds counterintuitive because a lot of the advice that's out there is every month contribute to these accounts. That works perfectly fine for the majority of compensation structures. But in your situation, because you have so much of that variability, there are going to be some months where you're not going to be able to contribute to the 529 accounts or not going to be able to contribute to a Roth IRA because your income's lower that month. And you're going to have to wait 2 months until the bonus hits. And then that bonus is going to be enough to fund everything and then some. So waiting for those types of contributions until either the beginning of the year or the end of the year to say, all right, it's time. Right, it's January. Bonus just hit for the fourth quarter. So now you have all this excess money. You can allocate some to go fund the kids' 529s for the year. You already have your savings buffer set. Go ahead and fund the backdoor Roths for the year. So those are done. And then keep a good amount in the buffer so that way you're able to weather those storms of the variable income. And so that's where really when we start thinking about more of a flexible contribution strategy to it, it's not necessarily flexible on if you're going to contribute or if you're not going to contribute. In many cases, it's not that you don't have the income. I imagine you're in the same boat where you would look at your tax return and say, the money's there. So why on some months do I feel like we don't have enough money to add to a 529 account for college and other months it feels great, right? That's the issue, is that you're going to have to start thinking about contributions as a yearly amount as opposed to a monthly decision that you're making. So as bonuses come in, what are the yearly goals that you need to check off and what's going to be left over? All right. So our final question, this one's a long one. I'm an internal medicine physician earning about $400,000 a year. After 15 years of building my career, I've saved around $2.5 million across the 401k, backdoor Roths, and a taxable brokerage account. My husband works part-time. We're raising 2 kids. Our home is in the Bay Area, has appreciated quite a bit. So I think overall we're in a strong financial position. Lately, though, I've been feeling burnt out. I don't want to stop working completely yet, but I do want some more flexibility and a slower pace. My long-term financial goal is financial independence. And can I afford to cut back? And if so, how soon? So loaded question, a lot of stuff to take into account here. What I will say is that 15-year mark is usually the point where we start to see a lot of that burnout. And the reason for that is, I think, twofold. Not only are you deep into your career at that point, but you haven't really seen a lot of the fruits of your labor yet, right? You're paying off the student loans, you're paying down payments on a house. So all of this is not in the accounts. You're not opening up your brokerage account and seeing these big wins. And I'm not saying that the 2.5 million is too shabby. That's a great spot to be in. And roughly at 15 years in, even if you did nothing for the next few years, money typically doubles in the stock market every 10 years on average. So if you've got 15 years to retirement, you'd expect probably a $6 million portfolio or so at retirement, even if you didn't add anything in there. Now, I'm not recommending that. I think you should still add to that retirement account. But it does start to hopefully put things in perspective a little bit, that you are at the top of the hill. And the first 15 years of career are going to be a mess from a burnout perspective, because you're starting off in the beginning. You have all these other financial stresses at home, right? You have the house and the kids and all of these things, and everything's just getting started up, and startups cost money, right? Everything's there. You're not building equity in the house yet. Looks like you have some opportunity with the Bay Area with appreciation there. So that's a win, right? But that win came from the market forces, not necessarily from you building up equity in the house, because the beginning portion of that mortgage, everything's going to interest anyway. So you're not getting any principal buildup. So during that first 10, 15 years, you're going through the long slog of pulling everything together, but you're not opening up your brokerage account and saying, I've got $10 million in here, so it's all worth it. The bright side is, generally after this point, we start to see some of that diminish because some of those stresses start to disappear. So right now you're dealing with work stress and all the other stresses. As the kids grow up, you're not funding a college account, they're out of the house, and you can already see it, even just from reading the message you put in here. You're mentioning the equity in the house. So you feel like that's a good thing. And that's true, right? So that's one less stress, where 5 years ago, that probably would have been a bigger stress in your mind, is we're having to pay off the mortgage and get some more equity built up in the house. But now that's done. That same thing is going to start happening, and it starts to really compound on itself, where the house has a lot of equity, so you feel a little safer there. Eventually the house will be paid off, and once the house is paid off, then you have extra income coming in every month. And then kids are out of college, or you're done paying 529 accounts. Now that weight is lifted off your shoulders as well. So all of these things start to compound to where you start having excess money hit your accounts. And that's the first step of that financial independence. You have excess money at the end of the month. You start putting it into investment accounts, and you're not far off from that, where in the next few years, you start breaching the $3-4 million mark, plus a ton of equity in your home. Net worth probably $5-6 million at that time. That's going to start opening up a lot of options. That 5 million mark is going to be pretty critical. And once you break through that, then it's going to open up the big question, which a lot of our clients have in your situation, I see all the time, is, are you going to stay in the Bay Area? Because what ends up happening is you build up all of this equity in the house, but you can't really have it materialized unless you leave. So if you stay, that's fine. You just have to save even more to be able to fund your life in the Bay Area without having to sell the house. What it does do is provides a great long-term care hedge. So from a financial independence perspective, that's kind of nice knowing that you'd have that there. And frankly, because of all the equity, it's going to give you some options to retire a little bit earlier, because you always have this huge parachute that is the equity in your home, that in a high cost of living area, if times were bad in the market, you had to sell your house, you would come out with so much equity that not only would you be able to buy a comparable house anywhere else in the country, but you're likely going to have a lot more money left over that could go into the brokerage account or into your investments to match out any loss that you experienced because of the bad financial times. I can't say you're out of the weeds there yet. I do think a lot of things are moving in the right direction for you to be financially independent. I don't think you're able to cut back completely, but I think maybe it's a good time to consider things like, do you need to be working overtime or taking on extra shifts? Probably not. And if there's a job that was paying a little bit less, but had better hours, I don't think it'd be crazy to start considering jobs like that, because you're at that point where your accounts are going to start contributing more to your accounts than you're going to be contributing to your accounts just from interest being earned. And now we jump into this week's rotating special segments. We have advisor red flags, where we jump into some of the shady or sketchy financial advice that we've heard of and try to avoid. And this one's not too egregious, but we had a client tell us recently that they had a financial advisor tell them that if you're maxing out your 401k, you're doing everything you need to do, you're going to be completely fine, which is good advice for maybe 90% of their country out there, but it is not enough for those who have bigger financial goals or more complex variable income options out into the future. And we can do some of the math on that. If you look at maxing out a 401k, you're looking at, we'll say for ease, $25,000 in that account a year. And you have, let's say, 25 years of contributions or 20 years of contributions to that. You're talking about $500,000 of principal that you're putting in there on average during that time, plus all the interest. That's going to get you the $1.5 million mark in your 401k at retirement, which is not bad at all. That is a great spot, and that puts you in a fantastic retirement if you're wanting to live on somewhere around $100,000 or so with Social Security income mixed in. So that's why that advice gets thrown around so much, is if you're maxing out your 401k, you're doing fine, because for most people, that's going to do it. But if you're in a situation where you think $100,000 is not enough from a spending perspective and you'd want to be up closer to $200,000, 401k is not going to cut it. Or if you're considering an early retirement, just maxing out the 401k is not going to cut it. And I'd argue that even if you did think that $1 million, 1.5 is completely fine for your retirement, I'd argue that your 401k holding all $1 million of your assets is probably not the best option. That we would want to have some money in a Roth IRA, we would want to have some money in a taxable brokerage account, mostly the taxable brokerage, because the tax impacts aren't that bad, but it creates liquidity. And one of the biggest things for financial stability, especially going into retirement, is going to be liquidity and flexibility. The more optionality you can build, the better. So if you have a situation where you have $100,000, $200,000 in a brokerage account, regardless of how much is in the 401k, that gives you the option to pull cash easily from an account without tax penalty or without some weird issues related to ages or anything along those lines. And that wraps us up. We went through all three questions on the physicians, talking about different types of incomes, whether it's coming from 1099, bonus income, and when you hit that point of burnout where is it time to cut back? Can you cut back? And hopefully give you some considerations there to think about in your own situations as well, of whether or not that's the case. And to wrap up the 401k, 401k is not enough. You need more than the 401k going into savings. Until next time. Hey, this is Stefan Scheib. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle in a future episode, just send us an email at podcast@scholarfinancialadvising.com. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.